mode.
Well, hello, active traders, and welcome to our presentation tonight on how you can spot high volatility trade setups fast. I'm Ken Calhoun, and I'm joined by my longtime colleague, Geoff Bysshe from MarketGauge.com. Hey, Geoff, it's great to have you with us here tonight.
Oh, it's great to be back. It's been too long.
I know, almost 2 years, but it's I'm looking forward to seeing what you got to say. You're one of the smart guys out there who knows what they're talking about, who can actually help traders. So I'm always happy to bring competency in front of an audience. So great to have you here.
Well, thank you very much.
As always, all information is for educational use only. I'm going to switch the presentation over to Geoff. He'll have it for the first 30 minutes, and then I'll have it for the second 30 minutes. So let me switch that over and look forward to seeing what you got to say. Thanks, Geoff.
Okay, great. So let me just show my screen and make sure everybody can see. So if you can see my screen that says pinpoint perfect entries and exits for swing trades, day trades, and option strategies for immediate profit and maximum potential, let me know. Okay, great. All right, so welcome everyone. Again, this is Geoff Bysshe from Market Gauge, and I'm going to do something a little different here because this is a unique opportunity to be co-hosting with Ken, and that is I'm going to start out with the beginning of a presentation that I would normally do that's longer, but I didn't want to do that presentation. I wanted to jump into and have time to really dissect the tactic that I'm going to show you and how it's been applied. You could have applied it to the recent market action. All right, so I felt that the recent market action being a correction in the market is going to be pretty applicable whether you're looking at this today or you're looking at it 2 years from now or 3 years from now. As you're going to learn shortly, have been using this for decades, so it's certainly not going to go out of style. And I know if you pay attention to this, you're going to like it because I've gotten feedback like this from Parab when I've taught this in the past. This instruction completely changed my style of trading. Before this instruction, I never looked at blank. I'm going to show you what that is shortly and was not aware of it. But after the instruction, this is all I trade is. All right. So the reason that I created this presentation and the reason I really like sharing this particular approach to the market is because I believe that when you can enter trades on the days that have a high probability of being immediately profitable, your trading just becomes easier and more profitable. All right. So the other reason I created this training was because I believe that when you can avoid getting hurt by big down days or gaps against you or the intraday choppy reversals that stop you out, again, I think your trading becomes easier and more profitable. All right, so just quickly, if you're not familiar with Market Gauge, it's not just me. I'm the one presenting here, but we've got 3 partners. We've been around since 1997. And we've been dedicated to helping people learn how to actively invest or trade safely and profitably with both automated trading systems and simple but professional caliber rules-based strategies. So I'm going to focus on the simple professional caliber tactics. Now, just a quick note about myself. I'm a former floor trader. So Market Gauge started in 1997, but I actually started trading with a mentor who is now my partner, Keith Schneider, in 1990, and that was on the floor of the Commodities Exchange. I was his assistant for a couple of years, and then I got my own seat, and we both still continued to work together. Obviously, we've been together since, so that's 28 years. That's pretty unusual. So on the floor, I traded futures and options, and what I'm going to show you is something that I learned on the floor. It was something that, as I said in emails out to our community, we didn't have charts in 1990 in our hands, and you had to figure out which way the market was going to go without charts. So I'm going to show you the tactics that we use, but now with charts, it's even easier. Now, we didn't stay on the floor. We moved off the floor, Keith and I. We went on to manage money for one of the biggest and most successful hedge funds in New York, Millennium Partners, which was a quant-based fund. So as a result of going into that quant environment, we've developed numerous applications and trading systems and courses to help that have now helped thousands of traders trade with the market gauge professional edge. Now, what I'm going to show you again is something that we have built into some of our automated trading systems. Now, in the larger presentation here, I would be showing you 3 secret market conditions that enable you to anticipate the market's trend and daily highs and lows for pinpoint perfect timing. All right, but as I said, I'm going to give you the accelerated version. But before I can even give you the accelerated version, I have to give you the meat. All right, so we're going to jump over the 3 secrets, and we're going to get right into the first one, which is the opening range. All right. Now, when I say the opening range, how many of you know what I'm talking about? All right. Now, I recognize some of these names here. So, Elton, you better raise your hand because I know that you should know. All right, good. So some are saying yes, some say no. Well, too many people believe that when we talk about intraday price action, that it's only for day traders. Well, as hopefully I'm going to show you, it's not only for day traders. It can really help you with your entries and exits on your swing trades too. Right? So if you don't look at the intraday price action, you could be missing valuable information. In fact, while I'm not going to get into it in this presentation specifically, oftentimes I will know which stocks I'm going to trade tomorrow based on the intraday price action of today, and we're talking swing trades. All right, so I have another question for you. Do you look at daily candle charts? All right, well, if you do, what if you can anticipate the daily candle pattern rather than wait until the end of the day? All right, what if you could anticipate that this was going to be that big green day that you're waiting for in order to enter that swing trade? All right, well, you don't necessarily have to miss that first day, right? Because I'm going to show you how you can anticipate when those big trend days are going to happen. I'm going to show you how you can anticipate when those reversal days are going to happen. And I'm going to show you how you can anticipate choppy days. All right, so the opening range. All right, with the opening range, you're going to be able to reliably anticipate the high and the low of a day before the day is over. You'll be able to anticipate the big trend days, and you'll be able to identify reversals. So this is why I love this. I mean, imagine if you can do this with confidence, how this can help your trading, right? So imagine being able to identify the high or the low of the day as it's happening, so you can buy near the high or the low. Imagine being able to identify when a stock or ETF is about to trend for the day, so you can enter these great trend trades early. And imagine being able to know which gaps are likely to reverse or continue, so you don't get faked out. All right, so the opening range. Well, the opening range, as I'm going to define it, is the first 30 minutes of the day, all right? The first 30 minutes, meaning from 9:30 to 10 o'clock, you're going to take a look at what is the high of that first half hour and the low of the first half hour. Now, I look at 5-minute bars because it gives me more information, but you could just as easily look at a 30-minute bar, and then you would know if the market moves above that first bar, you're above the opening range. If you're below it, you're below the opening range. Now, before I even go into the details of this, a common question I get is, okay, well, what do you do for the first 30 minutes of the day? And the short answer is nothing. Nothing. You wait and just observe and let the market give you information. Now, there are more strategies that look at different time frames of opening ranges. You can look at 5 minutes. I like to look at 5 minutes as well. But in order to get you started, I'm going to focus your attention on the 30-minute. But I am going to warn you that the 30-minute and the way you trade the 30-minute is slightly different than what you would do with the 5-minute. All right. So with the 5-minute bars, the highest high in the first 30 minutes is going to be your opening range high, and your lowest low is going to be your opening range low. Now, if we just illustrate this visually, we can put a green, my lines are green for the opening range high and red for the opening range low. And the basic rule of the opening range is that in the first 30 minutes, the market's just kind of adapting and adjusting to the overnight news. It's dealing with any reactions, and very typically the market will overreact to news. Now, as a result of that, the first 30 minutes define the boundaries of emotional sentiment in that market for that day. And that market could be any market. It could be an ETF on sectors. It could be an individual stock. It could be the markets. And we're going to focus for the most part on ETFs around the markets because you can really leverage the power when you do it this way. Now, if the market trades above its opening range, we consider it to be in a bullish mode and expect it to continue to trend. If it trades below the opening range, then it's a bearish mode and it should continue to trend. Now, this may seem pretty simplistic, but it works. And now, can you see how I didn't even need charts to know whether or not I should expect the market might reverse or continue to trend? All I had to do was write down at the end of the first half hour what the high of the day and the low of the day was. And those were my key numbers for the for understanding where I should be. Should I be long? Should I be short? Should I expect the market to reverse? Because as you're going to see, this 30-minute high or low is often the high or the low of the day, and that gives you a huge edge. All right. In fact, if you take this opening range and you combine it with three other simple indicators, you can dramatically change the statistical probability of your ability to guess whether you're going to be a high or low of the day at the opening range. Let me reframe that. So we have three different conditions that we look at, and if all three of those conditions are bullish, then 62% of the time the opening range low will be the low of the day. If those indicators are bearish, 24% of the time that opening range low will be the low of the day. Now, if I look at all days, the opening range low is the low 27% of the time. Now, I know that's a lot of numbers, but think about how that applies to your trading. If you wanted to put your stop under the low of the day and have the best odds of it not getting stopped out, you would want to do that when you have these, what we call the 83% trader's advantage. 62% of the time, the low of the day is already in at 10 o'clock. All right. And the opposite is true if you look at the highs. All right. So if you're in a bear trend, 39% of the time, the high will be set in the first 30 minutes. If you're in a bull trend, only 22% of the time. All right. So the opening range is one powerful factor, which 50% of the time, the high or the low will be determined in that first half hour. All right. So here's how it works with a little bit more detail. To keep it really simple, because I believe if you start simple, it will work and you can build on it from there. So with a 5-minute chart, we have the 30-minute lines after the first half hour. On a trending day, the way trending days tend to work is the market will break out of the opening range. It may have a little trouble there, but then it will continue. All right. If you just get out a little bit and come right back in, we're going to call that a head fake or a reversal. Now, if we use that as a basic definition, let's look at the 30-minute bars now. And I just took a choppy period of the market and I put a green arrow where the low was the first 30 minutes, a yellow arrow if the high was close to the first 30 minutes, and a red arrow if the high was the 30-minute high. You can see just by looking at the arrows that a majority of the time, in fact, 9 out of the 11 days, the opening range was either the high or the low or very close. Now, I didn't cherry pick this period. You can go do this test on any point in the market that you want. Now, here's how it changes when the market's in an uptrend. So if you look at this chart, again, 30 minutes, you can see we've got a lot of arrows on the bottom of the charts, because that's telling you those were the days where the low of the day was set or was very close to that first 30-minute level, right? That's how powerful this is. And if you turn it over and go into a downtrend, you'll see the opposite happening. All right, so what does this mean? A big picture. It means if you're in an uptrend, you can look at that first 30-minute low and know that it's good support. You can look for reversals there. You can put your stop under that level and not get stopped out as frequently. All right, so just if that's all you use this for, it can help you with your entries and your exits. All right, I use it for exits too. I wait for the market to open, and then I determine, based with the opening range, whether or not it's going to be a trend day against me. And if it looks like it's going to be a trend day against me, then I know that's the day that I want to get out. All right. Now, there's other factors involved, but that's a way when, let's say I'm in a swing trade and my thought process is, you know what, I can take my money here, or I could just wait for the market to tell me when to get out. The opening range is one of the primary drivers for that decision. So here's just how I would look at a given chart on any stock on an intraday basis. Again, the lines are just 30-minute ranges, and here are some of the patterns that you'll come to be very comfortable with when you look at the market this way. So this happens to be Apple because everybody likes Apple, but if we just take a look at how it's traded, 30-minute opening range gets established, it breaks down here. So this would have been a 30-minute opening range breakdown, but it becomes a reversal when you come right back in. Now, one of the really powerful things about the opening range is that it defines a line. So if I want to be bullish on the reversal when it comes back in, I know I can put a stop under the low of the day, right? So I can get a really tight stop and I can catch big moves like this. And this is what an opening range breakout looks like, right? Here's an opening range reversal that then fails and becomes an opening range breakdown, right back down, right? Here's a breakout that doesn't really go anywhere. But what this breakout does tell you after this big down day is it's looking like it wants to go back up. So if I saw this the next day, I would be looking for a good opening range breakout, which we get here, and it continues higher. Now, what about gaps, right? So here's Boeing after an earnings gap. Now, if you have a stock that gaps up on earnings, it should not come significantly below its opening range. Now, they're not all going to fall out of bed like this, but one of the things you should watch on earnings is that the market continues to go in the direction of that gap. All right, if it comes against it, watch out. Here's an example where it gaps higher, right, and then it pulls back, establishes an opening range low. And when you know the patterns to look for reversal, this is exactly where you want to look for it. And this is just a choppy day, but you're able to buy near the low of the day. All right, same thing here. Tries to break out, comes back into the opening range. The opening range becomes resistance. All right, so that's the basics. Pretty easy to understand, right? There are a lot of nuances there. This is one of those things. It's kind of like a video game. The best video games are easy to learn and difficult to master. So the opening range is simple to learn, and it just gets more and more powerful the more you learn about how to apply it in different situations. And if you use it correctly, you'll never get crushed for being on the wrong side of a trend day, right? Because it'll get you out. And you'll be able to anticipate the high or the low of the day with amazing regularity. And not only that, you know where it's going to be before the market even opens. It's going to be wherever the high or the low is in that first half hour. Now, when you know that the market's going to react to these levels, you can use them for stops and targets, all right? So you can use it, when you use it correctly, you'll know how much the price has to move beyond the range, in order to really use it correctly, you want to be able to have rules to determine how far it should break out before it's a trend day. You also should have some kind of reliable patterns that identify reversals at those highs and the lows, right? You don't want to just assume it's going to reverse. You need to have a reversal pattern. And it's always more powerful if you trade with the big picture conditions like the daily charts going in the same direction as your trade. So naturally, this is going to work on the markets too. So same idea as Apple, but I'm going to move through this page because I'm going to focus on the markets. in a much more detailed way. All right. So point is, you can use this on the SPYs, which is the ETF for the S&P 500. And actually, Daniel's saying, was it Daniel? Yeah, Daniel's saying this worked really well in futures today. Yep, absolutely. I actually learned it on futures. So now you can be confident about a general market direction by using the opening range, right? But you can make it even better, all right? And you make it better by not relying on just one index. So what I want to show you is this is the essence. If you walk away from this presentation with this really well ingrained, you'll be able to read the market with such more confidence. All right. Here's the thing: markets don't trend alone. They tend to trend best when you've got 2 or 3 of the markets going in the same direction. So what do I mean by 2 or 3? I look at the SPYs, the Qs, IWMs, and the Dow. All right. I'm going to see that in a second. Now, reversals tend to happen when you don't have them all doing the same thing, right? So use the market's the market's trend or lack of one to be able to trade the right stocks in the current condition and find potential trades for futures days and be able to understand which way the market's going. So let's take what I just described and apply it to the recent market action where the market topped out here. And so the way I've got this set up is, you can see I've got my daily charts of the market watch, as I call them. And I'm just I circle the day that we're going to look at in the 5-minute mode. So we're going to look at the high day where you can see the SPYs gapped higher, the Qs gapped higher, but not out to new highs. And if we look at what happened during the day and how you would read, how would you anticipate that that big red bar is going to happen? Now, you don't necessarily know the size, but look how the SPYs traded. They gapped higher. This is a new high for the SPYs. The SPYs tried to move higher here, right before 12 o'clock, but look what IWM is doing. It's not through its opening range at all. So that's a warning that it's not really looking to break out. Not only that, the SPYs break out on one bar and they're immediately back under. So the SPYs immediately roll over. IWM never makes it. That's not a market that's in complete agreement. And Dow wasn't much better. The only one that looked good was the Qs. Now, as the day wore on, the SPYs try to go back up and they can't do it. But at the same time, the Dow doesn't even come close. IWM is even weaker. So what happens when they finally all get in doing the same thing? They're all under their opening range, and the last hour to half hour turns into a big sell-off. All right. Now, so if you were watching that whole pattern, you don't have to be watching it tick for tick. You just have this up on your screen and you're looking at the big picture pattern of the day. And you can see that they're not all in agreement on the way up. It's getting kind of weak as the day progresses, and then in the end of the day, they're all in agreement on the way down, right? So you could sidestep that situation, and then you also know going into the next day, it was pretty weak. Now, let's take I'm not going to look at every single day. I'm going to take a look at the days that I think could easily head fake people. So the next day that could have been difficult was this big green day, right? It's a big gap down, but then it goes straight back up. So what did I say earlier? What do you do in the first half hour? Well, in this first gap down, and when this initial gap down, I can tell a lot of traders are probably just puking, right? They're like, oh man, I hate gaps, hate staying in overnight. I am trying not to look at the computer because so often this is what happens, especially in a bull market. I said I wouldn't talk about the 5-minute opening range, but here it's hard not to. What you'll notice in this is that the SPYs gap down, and then on a 5-minute basis, they basically never really pulled back after that first 5-minute high. The Qs never even pulled under their 5-minute high. And so that's your first indication that the gap might hold, or the gap may be a low. Then you just look for an opening range breakout. They all have a pretty clean opening range breakout. It turns out to be a trend day up. Now, whether you're looking to buy that gap down or you're just looking not to get stopped out of good trades. So even if you're not trading the markets, this is a scenario where if it's a strong bull market, the market gaps down like this, I go look at my strong stocks that I want to be a buyer of, and then as soon as I see the market breaking out to the upside, I know I can go buy my strong stocks, right? The ones that didn't gap down as much, the ones that are already breaking out of their opening range. So you have a nice, strong green day, right? Then what happens the next day? It gaps down again, right? Now, without this, you might be thinking, oh, another gap down, maybe same old story. But it does completely the opposite this time, right? It gaps down, it never really rallies. It establishes an opening range low that it tries to hold. But then when all of them get under their opening range, it's just a big down day, right? So you don't have to be surprised by it. Look, we can't change what the market's going to do, but we certainly can adapt to what it's doing. So the next interesting day here was markets pull back, SPYs pull back to their 50-day moving average. Qs are down pretty significantly when they're at their 50-day moving average. But now look what this looks like when you're looking at it on the opening range. Markets gap down, they establish their opening range, and then they can't really break down under the opening range. Now remember, the Qs are sitting right on their 50-day moving average at this point. The SPYs try to make a new opening range low. The Dow makes a new opening range low or low for the day. But the Qs are basically still hanging right around their opening range. There's a divergence there. The IWM is inside their opening range. This is not a market that wants to go down, even though it looks terrible. And then you layer on top of that, the Qs are at their 50-day moving average. As soon as you get the reversal, this is a great place to take a shot at buying the Qs on the 50-day. All right. Now, as it turns out, from a daily perspective, it doesn't work out, but you can see how the process is really easy, and very often you will wind up buying the low of a significant move. So that brings us to today, right? So yesterday we had a pretty ugly day in IWM. Now, IWM actually had a good day in IWM being short because, again, the opening range, and it was breaking through a key level. However, unfortunately, one sec. It came right back today, but you never know if it's going to come back, right? Well, with the opening range, as soon as the IWM got through its opening range high and all the other three were over its opening range, I knew that the negative momentum of yesterday was probably broken. Now, you might be thinking, but what if it didn't? What if it turned around? Well, for one, I wasn't a buyer today because I didn't trust it, but I knew that I shouldn't be negative until one simple thing happens. Had it come back, had these all rolled over and come back into their opening range, I would have probably gotten aggressively short and sold and put a stop over the high of the day. It didn't take any effort to glance at this every once in a while, pretty much until the middle of the day. And after the middle of the day, I figured it was too late and I wasn't going to try and look for a negative day. All right, so can you see how if you put this simple concept of opening range together with the 4 different indexes, you really get some incredible insight into the market. Now, like I said, this is just the beginning. When you combine this with reversal patterns, when you combine this with floor trader pivots, when you combine this with certain moving averages intraday, when you combine it with patterns with the prior day's highs and lows, it becomes even more powerful. But I just wanted to give you in this quick half hour the essence, or at least a great start of what you can do with the opening range. And so if you want to learn more about it, if this is the first time you've heard about it, I don't have anything for sale here, but I do have this link, marketgauge.com/OR secrets, and you'll get a more detailed webinar there if you're interested, and a free ebook called the Opening Range Handbook that will kind of solidify what I just described here. All right, so if you have any questions, perhaps at the end of this whole presentation we can do it, but for right now I'm going to hand it back over to Ken. and just say thank you everybody for attending. I'll be sticking around if you got questions later.
All right, well, thanks so much, Geoff. That's one of the more intelligent presentations I've seen in 20 years. I can use that myself, so I appreciate it.
Great. Well, I know you could use it with the way you look at the markets.
Let me ask you a quick question. Riddle me this. You're really super smart. Now, normally I scalp during the first half hour, but the other strategy that I like doing is intraday swing trading, where I put on the trade sometime during the morning and try and close it out toward the end of the day. It seems like the 30-minute strategy would be a really good filter to, if it's taking out a new OR high around 10 o'clock or so, it may be good for an intraday swing trade. So I'm going to test that out.
Oh yeah, absolutely. And with respect to the first 30 minutes, if you like to scalp in the first 30 minutes, so the way that we would look at that is we'd look at either the 5-minute, or when you really get good at it, you can look at the 3-minute opening range. But the other thing that it will do for you is you can look for the end of that 30-minute move to happen around 10 o'clock. So now, if you know your time frame is 30 minutes, you now know that by 10 o'clock, you've probably exhausted the initial move, which you may already know just from doing it.
Yeah, no, you're right about that part, but I didn't think about waiting till after 10 for intraday swing. So thanks. I'll use that myself. I'll figure out how to profit from it. So thanks. Highly recommend Geoff Bysshe. He's one of the smartest guys in the whole industry at www.marketgauge.com. He's an authentic expert, which is the kind of people I like working with. So thanks, Geoff. It was good.
Well, thank you.
I picked up some new things myself. Hey, traders, welcome aboard. I wanted to ask, if you would quickly let me know how many of you are day traders, how many of you are swing traders, how many of you do a little bit of both, like me. How many of you? So type in the word day, swing, or both. This is the audience participation portion where you put in the trade. Let me give you a quick writer downer here. Here's a quick strategy that you can use. In addition to the opening range, which I trade daily, I also like trading the closing range. And one thing that I found works relatively consistently is I trade TVIX because I like to live on the edge. I day trade TVIX all the time. I bought this, what was this, yesterday, right, at 28.76 right here, and sold into the high there. I like trading instruments with lots of volatility. And I'm going to start off by looking at some swing trading charts, but whether you trade TVIX or dust, in addition to the opening range, do look at the closing range, because oftentimes, especially if you're a manic day trader like I am, you can find lots of good setups into the close as well as the open. So that's good. Who am I? I'm Ken Calhoun. I'm president of Day Trading University and Trade Mastery. I've traded as much as 4.9 million in a single year. I'm a money show speaker. I was voted #1 author in the world by you guys, so thanks so much for stocks and commodities this past year. And I've been around since the dawn of time. Bum-ba-dum-bum. Anyway, let's take a look at some hot charts, shall we? Looks like a lot of swing in a few days. So let's start off with swing trades. And ask any floor trader this too, and it's really important. The most important thing to look at is the range. On a chart, if you're looking at swing trade, and this is Legg Mason, much more important than the chart is the math. Like I've said for years, the math is a lot more important than the chart patterns. When I evaluate a trade for tradability, the first thing that my eye is drawn to is this right column. You may have seen my stocks and commodities article on that. This is tradable because the range, you got a hammer here at the low, it traversed all 3 major moving averages. But the range here is what? 4 plus 3, a 7-point range, 20% range on a $3 stock or a $30 stock. Pilgrim's Pride, another excellent range. The reason that I want to bring these charts to your attention is to give you role models of the types of charts that you should be trading. Because in training, I don't know, thousands of traders now over the last 20 years, most traders trade choppy charts that have low trading ranges and don't have good upfront odds of working out. The biggest successful swing trades I've made are those that have what I call this pattern, where you've got, whether it's a gap continuation is my favorites, but second favorite is what I call an acceleration ramp, and that's where you get a slow, steady grind up, and then on high volume, you've got kind of a hockey stick breakout. Another candlestick pattern to look for is a series or a sequence of increasing large whole real body candles accompanied by volume, especially on a 3 day minimum basis, and that often leads to nice breakouts. So that's the first takeaway is before you trade anything, look at the right side of the chart, right? I mean, the chart that I picked on for 20 years is AT&T because it generally sucks. That's a good technical term. It's a, you know, I don't care what technical analysis tools you're using, you're going to get stopped out trying to trade AT&T. Look at the horrible range. It's got just a 1 or 2 point range. So you would not want to even consider that in the first place. Instead, you want charts that have nice ranges and nice directional trends. So to avoid getting stopped out, get familiar with charts that have consistent patterns. Now, one thing you may have seen, and much to my distress and many of my colleagues, is you've got a lot of young momentum morons out there advocating, you know, day trading thousands of shares of $3 stocks, and everybody gets killed who tries that, and then I inherit them and people come to me crying how they blew up their trading accounts trying to chase pop and drop $3 stocks on thousands of shares. I would much rather, you know, you take a handful of trades, maybe 5 or 6 consistent charts for swing trades, and use that as your foundation. So does everybody see the directional volatility of this chart? This is a beautiful chart for swing trading, AXSM. Notice I don't even know what the majority of these companies are. I have no idea what the companies are. I have no idea what even sector or industry group they're in. The only reason I know that I want to trade it is because it's going up. I'm a price action professional swing trader. I've traded millions of dollars worth of stocks, and I like to day and swing trade ETFs as well. If you trade cheap stocks under $10, make sure they have some kind of a directional uptrend channel, not the pop and drop ones. That's trying to do no harm and keep you guys out of trouble. Now, gap continuations are always good. One thing that I look at when I evaluate the trade worthiness of a chart is the ratio and size of green candles to red. If green wins, it's kind of like old school cars where you have an air fuel mix in the carburetor. We want a fuel rich mix. We want mostly green candles in the last week and a half or two. That gives you odds of a successful breakout. Always expect or anticipate that you'll get a false breakout within the first 20 or 30 cents above an obvious high. Let me ask you, if you were long, getting so excited here I even forgot to turn on the camera. I got all dressed up and everything for you guys. I'm a workaholic, it's what I do. Hey, so it's me, I'm Ken Calhoun. How you guys doing? Shut the front door. Anyway, where would you trail a stop on this if you're long? Let's say happy days you got in and you happen to get lucky and you got a gap in your favor. So you bought it back here at 10.5 or so, you're sitting on it. It's happy days, you're up at 14 or so. Where would you trail a stop on a swing trade? Feel free to answer right now. This is the audience participation portion of today's event. Do type in an answer of where you would get in. Okay, I'm seeing 13s, 13.6s, 13s. Whole numbers are good support levels. And I agree with you, 13 makes perfect sense. Now here's a quick advanced trader's tip. I'm going to try and record this too with Camtasia. Why not make it complicated? Anyway, oftentimes because you'll find whole number support, I do as many as 40 to 50 trades a day. I'm a maniac. I trade very actively. And the reason I do that is to be of service to all my members so that I can show them what works and what doesn't. I take a lot of stops learning what doesn't work so you guys don't have to. Because we expect whole number support, a probably smarter trailing stop would be, say, 12.8, because often you'll find it'll bounce within a nickel or a dime of a whole number, and it'll find support at, say, 12.97 or 12.95 or something, and then skyrocket back on up without you. So instead of using whole numbers, you absolutely have to use whole numbers for support and resistance, but from a trader standpoint, from a professional trading standpoint, you want to set your exit targets maybe 20 cents under whole number, or your entry targets to avoid a false breakout 20 cents above the whole number. So if you're looking for charts that make sense to trade, you want to focus on high volatility breakout patterns that make sense. Now let me give you another quick advanced trader's tip. One thing you can do, let me move this over here. so we can all see it, is what I call an arbitrage approach in ETFs. I do this for both day and swing trading. You can go long both the long and inverse version of paired ETFs and then scale into the one that works out, right? So for example, I'll often day trade nugget versus dust. Not today because they're kind of choppy. Today was a pretty awful day to trade, right? The S&P was kind of chopping and grinding around. Didn't do much open range breakout or breakdown. It was relatively quiet for most of the session. Let me give you another quick tip. The one thing that can help, and I've tested this out over the last 20 years since 1999 as a full-time trader. You have my word, it's absolutely valuable. This is a rider downer. Avoid end days. Avoid trading things that are inside previous day's high-low ranges. And the reason is because your quants and your hedge funds and algos and all that kind of stuff kick in using OHLC data, meaning if you get above the previous day's high, it'll likely run up. If you get below the previous day's low, it'll likely run down. But when you open, looks like an ORB strategy would have been a good long bias after, not until after 10 o'clock, but you can see here, if you open, especially, what I find is oftentimes, if you open inside the middle of the previous day's trading range, you got a range here, and you open in the middle, kind of like Neapolitan ice cream, for those of you who remember that, or a flag with 3 bands in it. If it opens in the middle of the trading range, that's usually not a good day to trade. Today we had an exception. It looks like we did finally get that ORB on the upside. But in general, when you're looking for what's worth trading in terms of individual equities and you're looking at which charts make sense to trade, avoid it if it's in the middle of a trading range. Wait until it breaks and holds above resistance, right? Above previous day's high and previous day's low. Now I happen to use the 1-minute chart. And one of the things you want to look at when you're looking for trade setups is make sure that you are avoiding inside range charts. Let's take a look. Let's say you're trading ETFs. For the long side, I like TQQQ. I'll often trade that or arbitrage that against. That's not confusing, is it? VXX became VXXB for a few months, and now it's back to VXX again. But anyway, I like trading TVIX against the long instruments like TQQQ. Another arbitrage approach is I'll often day trade LabU, the biotech long versus LabD, the biotech short. Now this is a swing trading chart, but do you notice that and I'd be fascinated to see the entire industry focus energy. I think there's a defined edge that you and I can have by exploiting the fact that that's the only guarantee in the whole stock market is that the inverse ETFs are correlated. The long and inverse ETFs are 100% correlated. So a better view would be to kind of zoom in here on the daily, but you can see they're all kind of horrible today, so we didn't have a lot of volatility one way or the other, but that's LabD versus LabU, right? Here is dust. It's kind of sideways, not doing a whole much. And there's nugget, exact opposite. There's TVIX versus TQQQs. And what's fascinating is that there is a defined edge there. So what I'll often do, for example, I've made so many winning trades with this strategy the last few weeks. Say if nugget runs up and starts to pivot and pull back after a breakout, and dust has correspondingly been selling off and starts to bounce, I'll put in buy stop orders, maybe 20 cents above the high for each of those 2 instruments. Whichever one works out, maybe the pullback and nugget comes back to life and keeps going up, I get long. Or if it crashes and burns and dust has been selling off and this is usually good after 10 o'clock. So after the initial ORB, it's for usually like a 10:30 or 11 o'clock reversal. Often you'll see the big pivot occurs, and that's a tradable activity. Okay. Another thing to be aware of is, like I mentioned, closing range breakouts, trading the close, and often I'm using the old version of e-signal because I've used it the last 20 years. I'm a holdout. I don't use the new stuff. I don't like the newfangled stuff. I like old school stuff. Anyway, as an active trader, you owe it to yourself to identify repeatable patterns. So for example, in TVIX, I daily will trade the closing breakout because it is a repeatable pattern. There's that day. There's this day was early. Do you notice, please, that 4 out of 5 days, as a pattern day trader, you're always looking for how to make money. Like I was trading this into the close. I bought right over the 26th today. Do you notice the spikes up right before the close? The reason for this is just because institutional traders who are short will often cover their shorts into the close, right? So you see a short squeeze off a previous low. You also have speculative longs that know things often will run up into the close. And this is not just for TVIX, but for any equity that you're trading. You've got ORVs, but you've also got CR, or closing pivots. Maybe CPs would be a good initial for that. But often you'll see a closing pivot, and I will often sit and wait for it to sell off and then start to bounce and put on a 200 or 300 share trade and trade that bounce on the way up. So those kind of things that are strategies that when you look at as an active trader is, first of all, define what your edge is. Mine is trading gap continuations during the first half hour. So if something gaps up, I'm long. And I was trading this and I was up 450 bucks right here. And then I scaled out right, not at the top, I was like 40 cents off the top. But that was my biggest opening up day in recent days. Was I bought the gap up. I'll often buy a gap continuation pre-market even. So for those of your intraday traders, that's another strategy. If you see a gap up above, the trick is it's got to be above the previous day's high. It's got to be out. It can't be in. An in day is here. In days are usually horrible, right? In days usually kind of chop around and grind and all that. Out days make for really good initial gap continuation plays, or things that sold off and gap up, right? I was in this guy long, it's either 70 or just 100 shares, and I sold the pivot high a couple of days ago. I was all cash last night, which is good because it gapped back down. But anyway, do you start to see these patterns? If I could circle those, I would. You can see the circle there. You can see the pivot long there. You can see a pivot long there. You can see a pivot long there. Anything that repeats itself consistently is exploitable. And as a trader, you owe it to yourself to just trade rock star charts, right? The strongest charts, the biggest trading ranges. So whether you're day trading instruments like our leverage 2 and 3x ETFs and ETNs, or if you're looking for good, strong, consistent swing trades, you have to visually identify the trading range to make sure it's worthwhile. Now, a lot of you may have struggled trying to trade cheap stocks, say under $10 a share. We've had a lot of gap and trap, or gap and crap, whatever you're going to call it, gaps that didn't do anything except chop and sell off the last couple, 3 weeks, right? Especially true for the under $10 stocks. That's why those are generally horrible, eschewed by or not traded as aggressively by experienced people who've been around for 20 years trading. And that's where you've got college kids and speculators and inexperienced people, the blind leading the blind, saying, let's buy 5,000 shares of a $3 stock that's gapping up. And they make it look so easy, but when in fact they're actually doing mirror accounting. They'll put a long in one account and simultaneously have a confederate go short in a different account, so they don't worry about it. But you and I don't have that luxury, so avoid anybody that says, you know, day trade cheap stocks as a rule of thumb. And they're all over social media. They've infested the trading like little cockroaches or mosquitoes. Psh, get rid of them. Shoot, shoot, shoot. We want things that actually have a shot of running. So if you are trading cheap instruments, make sure that they've got some consistency directionally, whether you're swing or day trading it. Make sure the volume is there so you don't have people front running. Make sure the volatility is consistent so that you don't get stopped out and chopped out. How many of you struggle, as I've done for 20 years in tens of thousands of trades, with avoiding, I don't really struggle with avoiding false breakouts. What I struggle with the most is, especially for intraday trades, is you get in a trade and it does work out, But if you use really tight stops like I do, you get shaken out a lot. How many of you get shaken out often, or more often than you'd like? That's my biggest challenge. The one thing that I would teach you to avoid that is use smaller share size with slightly larger stops. So if I'm using, say, a couple hundred shares, I might use a 10 or 20 cent stop to keep it kind of tight, but then I get shaken out. Instead, what I like to do is maybe 50 or 100 shares, and I might give it 30 or 40 cents, and that way it avoids the false breakout. Another strategy that you may find is late day breakouts like we had in JD today. My live room members got the alert to get in long over the 30 cent, I think it was 30 cent mark in JD today. 29.30. And that was a nice breakout to the upside. Again, a gap up that fills the gap and then bounces. I've only got a few minutes left here, and I'm not going to stick around too long because I know running late. I was really fascinated with Geoff's presentation. It's one of the smartest, well thought out ones I've seen ever. So thanks, Geoff. I'll use that. I'll use that. So anything that's come up with by smart people is worth a test, right? And by the way, when you're testing, that doesn't mean you try it once and then give up if it doesn't work out immediately. You try it a few dozen times, right? Let's see here, standard chart. What am I trying to do here? I'm trying to get back to a 2-day chart. So what I want you to look at in JD, and by the way, I find for some reason there's a lot of correlation between JD, Momo, Twitter, AMD. Those tend to track together, just like the pot stocks were smoking higher today, like CRON and CGC and AG, I want to say AGP and whatnot. But anyway, one of the single best pivot in the world is not something that's down in the muck down here. The single best pivot is a gap that fills and bounces approximately off the previous day's high. And once it breaks above that, that's a go-to. And you have my word on that. I've tested that out with thousands of real money trades. The single best pivot in the whole stock market, whether you're day or swing trading. And Geoff made a good point too. I like working with smart people. It's refreshing. Anyway, the point is, if you have a gap up and it fills, if it starts to bounce off the previous day's high, that's the single best pivot out there. That'll often bounce. That's the one that you want to take. The bad ones are ones that are down in the muck under the previous day's low, and it's like a stair step down. It'll go down and bounce a little bit. You get in, it stops you out, and keeps going down. You say, surely this will be it, and it bounces in. That story ends badly. So, if you're one of those people, whenever I speak at the money show events in Las Vegas, New York, Dallas, wherever else I speak at them, I always get nervous laughter when I say, if you conceal your trading losses from your spouse, you might have a problem, right? Bada bing. So stop the madness, trade smaller, trade more frequently, spread your risk and diversify, and learn these patterns, right? Learn from people like Geoff Bysshe and Market Gauge. He and Keith and Mish are three smart people. They're three of the sharp pencils in the bunch, right? You want to learn from people like them and from myself and others of us who've been around 20 odd years. Just think, a lot of these momentum kids 20 years ago when people like Geoff and I were trading, they were in diapers or they were in 3rd grade. Do you really want to risk your capital learning from people, even though they try and make it sound good on social media? I would say no. Learn instead from established professionals who know what we're talking about. Anyway, so that's a rider downer, is the pivot. So I'm trying to give you arrows for your quiver, like Robin Hood, but in trading. So the closing range pivots is one strategy. The bounce off of the previous day's high for a gap reversal is another one. Straight gap continuations are historically good, but we haven't seen a lot of those occur this last couple of weeks. Most of the gaps lately have been gap and trap. Other good patterns, especially valuable for those of you who swing trade, are those in which visually, I'm just giving you should write these down. These are rider downers. Check to see like the ratio of green to red candles in the last week or so. And you don't want a Christmas tree. You don't want half green and half red. What you want is mostly green, right? Show me the money. show me the green on my screen, baby. So what you're looking for is out of the last 5 to 7 days, you want to have 5 out of 7 or whatever. Majority of them be green days with large green candles on increasing volume compared to congestion zone volume, which down here is around 500 a million. We're up at about 1.2 million average during the breakout. So is that good stuff? Yeah, Dan said he's had that happen. Yeah, avoid inside days. That's what someone called Trader says. Yeah, it's a good point. All right, well, I'm going to wrap up here shortly. You're welcome to join me at trademastery.com. I wanted to thank all of you for being here with Geoff and myself. My call to action is simple. I've got a free membership area at trademastery.com. On the front page, you can click where it says join free. So that's a deal. And I've got lots of videos and everything else in there. The other thing is if you do day trade, you may want to try out my Trading the Open live trading room. And it's only $7 for a 2-week trial and $97 if you stick around. And we meet every single day from 9 to 10:30. So that's at www.tradingtheopen. Let me get this. I've got all these monitors, right? Anyway, tradingtheopen.com and do a 2-week trial for just $7 now. Now that might change in the future, but for now that's what it's at. So anyway, on behalf of Geoff, Bysshe, and myself, I just wanted to say thanks so much to all of you. We don't overlook your time and your energy to be here. I know you could be watching YouTube videos or something instead. So thanks for being here, and thanks, Geoff, for joining me. It's great sharing the stage with you. You're one of the sharp guys, so it's always a pleasure. So thanks, Geoff.
Thank you very much, Ken.
All right, so we'll see you guys next time. Remember, marketgauge.com and trademastery.com, the places you want to be. So take care and best wishes for success, and we'll see you on the other side.